Over the last few years, investors have been chasing themes like AI, defense, electronics, renewables. But there's one theme that is quietly delivering exceptional growth. It's coffee. Now, at first glance, coffee may not seem like a very exciting business. After all, how much innovation can happen in a cup of coffee? But once you start digging deeper, you realize that the industry is going through a significant transformation. Consumers are shifting towards instant coffee, premium coffee, and convenience product. Global retailers are increasingly outsourcing manufacturing via private label partnership. And perhaps most importantly, a premium category called freeze-dried coffee is emerging as one of the fastest growing segments within the industry. This has created a massive opportunity for companies like CCL products and vintage coffee. Just look at the numbers. CCL product has more than tripled its revenue over the last 5 years, while vintage coffee has grown at an even faster pace. The interesting part is that while both companies operate in the same industry, they're actually very different investment stories. CCL is a large established player with global scale, growing brands, and a strong balance sheet. Vintage, on the other side, is a much smaller company making an aggressive bet on capacity expansion and premium coffee product. So in this video, we'll first understand the coffee value chain, then why freeze-dried coffee is becoming such an important growth driver, then what is driving the growth of CCL products and vintage coffee, and what management is guiding for FY27 and beyond, and finally, whether these coffee stocks deserve a place in your portfolio or not. Alright, let's begin. Let's first understand how the coffee industry actually works, because most people consume coffee every day but have very little idea about the value chain behind it. So everything starts with coffee plantation. Farmers grow coffee cherries which are processed to extract coffee beans. These beans are then sold to coffee processors who convert them into various coffee products consumed around the world. Broadly speaking, coffee products can be divided into 3 categories. First is roasted and ground coffee. This is the traditional form of coffee where beans are roasted, ground and then brewed. Whether it is South Indian filter coffee, espresso, cappuccino or coffee served at cafes like Starbucks, it all starts with roasted coffee beans. This segment is associated with premium coffee consumption and cafe culture. Then second category is instant coffee. This is the coffee most people are familiar with through brands like Nescafe or Brew. So instead of brewing coffee from beans every time, you can simply add hot water or milk and the coffee is ready within seconds. The convenience factor here makes instant coffee extremely popular across the world. But even within instant coffee, there are different categories. The most basic form is spray-dried coffee. Here, coffee extract is converted into powder using hot air. It is cost-effective and used in mass market products. Then there is freeze-dried coffee, which is considered a premium category. In this process, coffee is frozen and dehydrated at very low temperature. That helps in preserving its aroma and taste. As a result, freeze-dried coffee typically command higher pricing and better margin. Then third category is coffee premixes, which have become increasingly popular over the last few years. In this, your coffee, sugar, milk solid and other ingredients are already blended together. You just need to add water and your beverage is ready. Now selling raw coffee beans generate the lowest value. Processing them into instant coffee generates higher value and converting them into branded or customized premixes can generate even higher realization and margin. And this is where companies like CCL product and vintage coffee enter the picture. They buy green coffee beans, process them into instant coffee and then sell the finished product to global brands as well as your supermarket and private label customers across different countries. So when we analyze coffee companies like CCL product and vintage coffee, we are not really analyzing a consumer brand. We are analyzing coffee processors and exporters that sit at a very crucial point in the entire coffee value chain. Their success depends on factors like coffee consumption growth, export demand, product mix, capacity expansion, and their ability to move towards higher margin product like freeze-dried coffee. This is where the real investment story begins. Now that we understand the coffee value chain, let's discuss the two companies. Now at a first glance, CCL product and vintage coffee may appear similar because both primarily operate in the instant coffee segment. However, they are operating at very different scale. CCL product is one of the largest instant coffee manufacturers globally with manufacturing facility across India, Vietnam, and Switzerland. Over the last 2 decades, it has built deep relationships with global retailers, private label brands, and coffee companies. Vintage coffee, on the other hand, is a much smaller player. It is currently in the scale-up phase and is trying to build capacity, expand the exports, and move up the value chain. Because of its smaller base, vintage has potential to grow faster, but it also carries higher execution risk. At the moment, CCL market cap is around 16,000 crore, whereas vintage market cap is around 2,500 crore. Also, from revenue perspective, CCL FY26 revenue is around 4,500 crore, whereas vintage revenue is around 550 crore. Profit-wise, CCL made around 388 crore in FY26 versus 72 crore for vintage. However, please note that both are export-oriented company where export contribute 80 to 85% of CCL business, whereas it is 95% in case of vintage. Basically, instead of spending billions building a consumer brand like Nescafe, both companies are focused on becoming a manufacturing partner for global retailers and coffee brand. Now, if you look at financial growth of both companies in last 5 years, CCL product revenue has jumped 3.5 times and profits have doubled. In trailing 12 months, revenue growth is much higher with 44% jump and 25% profit growth. Vintage on the other side is compounding at much faster rate with revenue growth of 15 times and profit growing exponentially on the smaller base. Trailing 12-month growth is also high with both revenue and profit growing 80%. Now the question is, what is driving growth for both companies? And what is expected from FY27 and beyond? Let's discuss it. So the first driver is increase in global coffee consumption. As more people enter the workforce and urban lifestyle become busier, coffee consumption tend to increase over time. Then second driver is growing popularity of instant coffee and premixes. So instead of brewing coffee from beans, people can prepare a cup within seconds. Then third and perhaps the most important driver is shift towards freeze-dried coffee. As we discussed earlier, freeze-dried coffee is a premium form of instant coffee that retain better aroma, taste and quality compared to your traditional spray-dried coffee. As a result, it commands significantly higher realization and margins. This is why both CCL and Vintage are aggressively expanding their freeze-dried coffee capacity. The industry is gradually moving towards premium product and freeze-dried coffee is emerging as one of the biggest beneficiary of that trend. Then fourth driver is the rise of private label brands globally. Retail chains and supermarkets are increasingly willing to sell coffee under their own brand name. However, they typically do not have manufacturing capability. And that's where it created a significant opportunity for companies like CCL and Vintage that are manufacturers of coffee for multiple brands across different countries. Now, one important difference between CCL and Vintage Coffee is that CCL is no longer just an instant coffee exporter. Over the years, the company has also built its own consumer brand under the Continental umbrella that offer Continental Coffee, Continental Extra, Continental Special and other variants. I personally tried its Continental Extra and found it excellent. They are also available on quick commerce platforms like Blinkit, Swiggy. So in case you want to try it, you can have a look at it. So while export contribute to dominate 80-85% of company's business today, the branded segment gives CCL an additional growth lever that Vintage currently lacks, which is 95% export company. So if Continental continue gaining market share in India, CCL could gradually evolve from being a pure coffee manufacturer to becoming a stronger consumer brand as well. This diversification may partly justify why investors are willing to assign a premium valuation to CCL compared to pure export-oriented coffee processor like Vintage Coffee. You can't simply look at PE on absolute basis and say that Vintage valuation is cheaper than CCL product. There's a reason behind it. And the reason is CCL diversification into consumer brand. So while rising coffee consumption provides the foundation, the real growth driver are premiumization, freeze-dried coffee, private label manufacturing and capacity expansion. And this is where outlook for FY27 and beyond becomes particularly interesting. Now here you must understand the impact of coffee prices on both companies. At first glance, rising coffee price appear to be positive because that result in higher reported revenue. However, the reality is slightly different. Both CCL and Vintage primarily operate on a cost plus model. It means they buy green coffee beans, process them into instant coffee and then sell the finished product to consumer. If the price of green coffee rises, the company generally pass on most of the increase to customer. As a result, the selling price also rise and this create an interesting situation. Suppose coffee prices increase by 25% and volume increase by 20%. Now revenue growth here would be 45-50%. However, a significant portion of that growth is coming from higher coffee prices rather than higher quantity sold. And this is exactly what happened in FY26. Coffee prices witnessed a sharp increase globally due to supply concern in major producing countries like Brazil and Vietnam. As a result, both CCL and Vintage benefited from high realization that boosted their FY26 revenue growth. However, if coffee price stabilize or decline in FY27, volumes may continue growing at a healthy rate, but reported revenue could slow because the pricing tailwind disappeared. The good news is that coffee price fluctuation generally have much smaller impact on the profitability as compared to revenue. In fact, for companies like CCL and Vintage, the more important factor is not whether coffee price rise or fall. What matters is whether they can continue increasing volume and shift consumer towards high value product like freeze-dried coffee and premixes. That is where the real long-term value creation lies. Now let's discuss management guidance for FY27 and beyond. Now that we understand what is driving the coffee industry, let's look at what management is expecting over the next few years, because this is where the story of CCL product and Vintage coffee start diverging. Let's start with CCL product. Here management has guided for around 15% volume growth for FY27 with similar 15% EBITDA growth. That may not sound very exciting compared to the explosive growth reported in FY26. But you must understand that FY26 benefited significantly from higher coffee prices. Going forward, management is guiding based on underlying business growth rather than commodity price fluctuation. One thing that stands out is that CCL is not just focusing on export anymore. They're also investing heavily in their branded business. They want to maintain around 25% annual volume growth in their domestic branded segment and has an aspiration to double the India branded business every 3 years. Another interesting aspect is capital allocation. CCL is entering a period where it can grow without major capex. Management believes that existing capacities are sufficient for next 2 years and expect only maintenance capex of around 25-35 crore annually. Current capacity utilization is around 65%, which means company has significant room to grow before needing fresh investment. With the targeted volume growth, utilization could move to around 70-73% in FY27 and potentially 80-85% in FY28. Now let's look at Vintage coffee, because this is where the growth story becomes far more aggressive. Vintage is in the middle of a major capacity expansion cycle. During FY26, company increased its capacity from 6,500 metric ton to 11,000 metric ton, and management expects this entire capacity to operate at around 95% utilization during FY27. That means production could reach roughly around 10,200 to 10,400 metric ton during the year. Also, management guided that they expect realization to increase by 2 to 3%. Now I did a basic math to calculate the expected revenue for FY27, and as per my calculation, Vintage should be able to deliver around 850 crore of top line. That's 50% revenue growth expected in FY27. And I'm also expecting similar 50% growth in profit after tax. Going beyond FY27, the focus is on freeze-dried coffee. As we discussed earlier, freeze-dried coffee is the premium segment of instant coffee industry and typically commands significantly higher realization and margin. To capitalize on this opportunity, Vintage is building a new 5,500 metric ton freeze-dried coffee facility, which is expected to commence commercial operation around July 2027. This facility alone involves an investment of roughly 550 crore. Management expects the freeze-dried coffee business to become a major earning driver over the next few years. As the new plant ramp up, EBITDA margins are expected to improve from around 18% in FY26 to 19% in FY27 to 20-21% in FY28 and potentially 22 to 24% by FY29 once the facility reaches optimal utilization. What is encouraging is that management appears confident about demand visibility. According to company, it already has strong customer interest and order visibility from the expanded capacity. Given that the global instant coffee market is estimated at roughly 1 million ton and continue to grow every year, management believes its additional freeze-dried capacity can be comfortably absorbed by the market. Another important trend is product mix improvement. Vintage is gradually increasing its share of premium products such as agglomerated coffee and consumer pack, which should also help improve realization over time. However, unlike CCL, this growth for Vintage will require significant capital. They expect to add 400 crore of debt over the next couple of years to fund their expansion and working capital requirement. Therefore, while the growth opportunity is potentially larger for Vintage, execution risk is also considerably higher. So what is the takeaway from this entire discussion? The first thing is that coffee industry appears to be benefiting from multiple structural tailwind. Global coffee consumption continues to rise. Consumers are increasingly shifting towards convenient products like your instant coffee and premixes. And perhaps most important, the industry is gradually moving towards premium category like freeze-dried coffee that offer better realization and margin. Then second takeaway is that while both CCL product and vintage coffee operate in the same industry, they are actually very different investment story. CCL today is more established business. It has built global customer relationship over decades, operate across multiple geography, has a growing branded business under Continental Coffee, and is entering a phase where it can continue growing without significant capital expenditure. As a result, the execution risk is relatively lower. Vintage, on the other hand, is a much smaller company that is entering an aggressive capacity expansion phase. Company is making a large bet on freeze-dried coffee, expanding capacity, and moving up the value chain. If management execute well, the growth potential could be significantly higher. However, vintage is also taking high debt and execution risk is naturally much higher. Having said that, you should also understand the key risk. Like your coffee price fluctuation can impact revenue growth, export demand can fluctuate, and both companies are heavily dependent on global market. More importantly, a large part of the investment thesis for next few years revolve around the successful ramp up of premium product, especially the freeze-dried coffee. So if I had to summarize in one line, CCL looks more like a relatively stable compounding story, whereas vintage looks like a high risk, high reward game. Personally, I find the overall coffee industry quite interesting because unlike many sectors where growth depends largely on domestic economy, these companies are participating in a global consumption trend. The key question now is whether they can continue moving up the value chain and capture a larger share of the profit pool rather than remaining commodity processor. And that is exactly what you should track over the next few years. Now, I'd love to know your thoughts. Between CCL product and vintage coffee, which company do you find more interesting and why? Let me know in the comments. And if you find this video useful, do share it within your circle. I'll see you next video. Till then, take care.